Hey everyone, Retire on Dividends here. I know it's been a long time since I made one of these series, but it's time to make a How to Retire on ULTY series. Long overdue, I know, but let's get to it. So before we even get into the numbers, let's talk about ULTY and what it is. So obviously, if you go to the YieldMax website, you can see under our ETFs, you go under YieldMax Ultra ETFs. It's the only one. It's been the only one for quite some time, which, it draws up the question, what about the others, right? We have a section for it. Why is it by itself, right? I don't think I've ever asked this question. Not sure if anyone else has, but again, it has its own section for a reason. So I assume there will be other Ultra ETFs in the future. But anyway, so here's ULTY. And when you pull it up on the website, you can see right off the bat, it's kind of small font, actually. They should make this bigger. Maybe they're not allowed to anymore. It used to be. But it shows an 84.23% yield, right? Obviously, that's pretty nice. And it has some information. Let's keep scrolling. Here's the distribution details and all, the history of it. The first distribution dates way back to March of 2024, which is kind of, when they paid monthly. So it says, it's actively managed, seek monthly income. All right, so obviously they have to update this. They did not update this because the ULTY pays weekly now. So obviously it changed from monthly to weekly. So maybe we will let them know after this. All right, let's keep moving on. And then here's their primary investment objective: to seek current income. Secondary objective is to seek exposure to the share price. Okay, blah, blah, blah. What else is new? So now if we look at the fund in general, the fund is blowing up. I don't know if you can see this. Obviously, this is my first time recording on the actual computer. Typically, the only time I use the computer is to go live. But whatever, hopefully it works out. Hopefully you guys can see. But the net assets, the total AUM, right, the assets under management is $1.6 billion, which is insanity considering where it came from. The fund did incept on February 28th of 2024. It has a gross expense ratio of 1.4, but it does have a waiver of 10.1%. So it's actually 1.3% at this moment. And yeah, the current price is $6.39. Well, no, I'm sorry. The current price is $6.41. The NAV is $6.39. All right, scrolling down, let's see what else it's got. It's got obviously the holdings. You could download that, which we'll get into the holdings in a second. And then it has the prospectus and all this other fun jazz in between. So before we go any further, what we're going to do is we're going to go through the prospectus, and then we're going to go through the holdings, and then we'll go through, the running the numbers and see like how soon you could retire on ULTY if you did decide to, put a chunk of money in ULTY. All right, so I have the prospectus up right here. This one is obviously updated, post change. As you know, ULTY went through a big change from when it started off. I think that happened in October something of 2024. But obviously, this is an update since that update, because when you hit download prospectus, it's always just going to give you the latest prospectus. It doesn't have the history, which I was hoping it did, so I can show you like the date of the change of the the actual change. All right, why is this not scrolling? All right, I guess I gotta scroll myself. You know what? Let me use the mouse pad. Yeah, let's do that. All right, so something interesting here to keep in mind. We talked about the gross expense ratio of 1.4. This 0.10, right? Waiver has a 3, right? Go down here. Okay. Advisor has agreed to reduce management to, well, it says 1.14. Well, even though it's 1.3, but whatever. But basically, I'm showing that this 0.1% will last until February 28th, 2026. So I know that it's irrelevant at the moment, but it's something to keep in mind. So the expense ratio may go up to 1.4 in the future. I don't know. Maybe they can always modify that and extend it to a later date. But we'll see, man. We'll see. All right, let's keep scrolling, see if there's anything useful here. No, nothing there. Nothing exciting there. Yep, there it is. The fund may hold underlying securities when the advisor determines a direct hold is more cost effective. Again, that's something that was not there in the beginning. And then obviously this shows that they can also do a synthetic. All right. So that, it's just some notes there. That was part of the change. The fund seeks to generate income, blah, blah, blah. Okay, nothing new there. And then, why invest in the fund? We already went kind of through that. So yeah, nothing too exciting. I'm not going to waste your time any further on the prospectus, but basically, they call it like a mini hedge fund. Basically, they could do whatever the hell they want. They could trade all the options and do, buy what they feel has the ultra high volatility and then trade options on it. And that's kind of what we're paying that big expense ratio for, right? Obviously, feel free to read through the entire prospectus, though, if you want. All right. So anyway, let's get to the file, which right now, this is a download of the holdings as of today, which I don't know if I'm airing this video today. I'm probably airing it tomorrow, but regardless, doesn't matter. These holdings are as of July 21st. And I just kind of show you like what they're doing. So if you see here, this is one of the holdings, Applied Optoelectronics, and you could see they own the physical shares, right? If you see the ticker and it has an actual ticker, yeah, they own the shares. And what they do is they sell covered calls on those shares, and they also buy a put. So, obviously the credit for the call is going to be, enough to pay for the put. So what's left over essentially is that's going to be what you're yielding, right? Essentially, obviously probably more, depending on what the underlying does, or how much you make on the put. If it does go down and the put is actually worth money, but like right now, this applied. I don't think I have the prices here, do I? No. I guess depends. This shows what the value is of each position, but obviously this is worth what, 35 cents per share, 20 cents per share. And these cost 98 cents, 83 cents per share to close. But depending on what the price of the underlying is, hopefully the covered call, we don't get blown through, because obviously there is no credit call spread. Instead of them buying a call with a higher strike, in case it does blow through your credit call spread, they buy puts for the downward protection. And the reason that is because look at this. These stocks, this has an implied volatility of 128%. Typically, if you're investing in stocks that normally have an implied volatility of this, this 120%, you're probably, you can guess that's a high risk, high reward. But, you want to protect the downside if you're going to invest in some degen plays, like these. Again, I don't know what this Applied Optoelectronics, but obviously it's super volatile. As we scroll through these, we can see some names that are familiar, right? Coinbase. It's not showing the IV for some reason. First Solar, Robinhood, IONQ, 96% IV, right? So we don't know. Mara goes down all the time, up, down, all around. They got some MSTR in there. But you can see like what they do is they invest in ultra high implied volatility stocks. And that's so they can pay you ultra high yield from the premium that they generate. But again, the new strategy that they did, and here's Tesla, for example. Tesla is actually, let me just pull up Tesla real quick on my phone. Let's see what their price is. Currently, Tesla price is $329. Okay, but again, this is as of the close on it's as of the close the past Friday. But so we have what? the hell did I say? It's at 329. So if you look here, they have a covered call for 345, covered call for, oh no, sorry, that's a put for 340. No, that's a call as well. So they have a call for 347.50 and a call for 345, and then a put for 295. Tesla being at 330 at the moment, obviously it's in between. So assuming the credit that they got for selling that call is larger than the expense for buying the put, then obviously so far so good. And by the way, these do expire on July 25th. All right. Now, you can go through the intraday trades to see like how much they're making for each transaction. And that involves a lot of effort for sure. But obviously just getting an idea, it's kind of why we pay them though. We pay them to do most of it. I know I cover Misty in detail, but ULTY is a beast of its own. And you can see for the most part, it looks like they're always buying a put, right? Oh, I stand corrected here. Well, so here's a good one here. Okay, so they got a VRT, ticker symbol VRT. What are they doing here? They got a call, they're buying a call, and they're selling a call. Where the hell is their synthetic? Where I don't see that they own the underlying. I guess this call, let's see what the price is. It's 125, 123. Okay. So that kind of represents their synthetic position. And then they're selling a call at 134 and 137. So it's pretty interesting. Again, this is why we pay them, so they can get creative and do what they think is best. Could you imagine trading this many freaking stocks, high risk stocks, and trying to make the right decision? But again, that's why this is such a high expense ratio, because there is very freaking busy, very busy fund, clearly, as you can see. But again, we're not here to really cover too much detail on the holdings. But the moral of the story is they invest in very high implied volatility, highly implied volatility stocks, and they either own the underlying outright, sell calls, and then buy puts, or they own it through a synthetic and then they sell calls and don't buy puts. It varies. It varies per fund, and the only way is if you follow it day in and day out, or you just download the intraday trades and take a look. But that's up to you if you want to do that. All right. So anyway, a couple other things. Obviously, when you download the holdings, it'll always show you the date that it represents. It shows obviously the ticker that you downloaded. When in this case, it's ULTY, right? And then between the stock ticker and QSIP, that kind of represents the position. Which the stock ticker, if they own the position, it would be just the ticker. But since you see all these numbers and you see a letter and this and that. That just shows the the options position. QSIP is more the same, and then security name more the same. But it depends what type of position, if it's an options position or if it's the actual holding. And then shares, outstanding shares. This either represents the number of contracts or it represents the number of positions that they're holding. Like if they own coin, this is the number of shares of coin that they own. If they're selling calls like here, that's the number of contracts that they're selling calls on, 250. And then this price represents how much the position is currently worth. And then the market value represents the total value that position is worth. So if you look all the way on the bottom, if you add up whatever the market value is, there's your $1.6 billion, right? This is the amount that the fund is worth, right? So you see cash on the bottom, 159 million in cash, and then all of the holdings in between, which we kind of went through, right? Which they hold a whole bunch of stuff. And then here's 88 million in this governmental bond thing going on, obligation fund. What else? That's it. Then going further, you can see the weightings, what percent of each that they own. Obviously, AAOI is 3% of the position. APP is 4% of the position, and so on and so forth. And then obviously net assets, that's just the total market value. which we spoke of. Shares outstanding, that's how many outstanding shares there are. So obviously, if more people buy, that would increase. And then number of creation units, basically, it depends. Like if you take actually the number of outstanding shares and you divide by creation units, shows 20. So each creation unit is 25,000. So the reason there's 10,335 creation units is because each creation unit is worth 25,000 outstanding shares. If you care, you may not care, but I'm just trying to explain to you the download of the holdings. And these are my fields that I just filled in, which grabs the ticker, it grabs the IV, and then it grabs the underlying name. I will, if you want, I can share this with you. I don't know. Let me know. I don't know if this is of any use, but we'll see as we get to the through this video. All right. Anyway, moving on. So let's get to the numbers. All right. So now one thing I want you to know as I take a sip of water is I'm only tracking ULTY and judging ULTY based on when they made that prospectus change. Because when ULTY first launched, they were kind of limited to doing the synthetic thing, selling calls, and that's it. They couldn't buy puts, right? They couldn't own the underlying. They couldn't do this, that, or the other thing. So that's really why when I make this video, I make it as of 10/17, which is, again, as of the prospectus change. Should I go further? I don't know. I'm probably not. Again, this is the date of the prospectus change. That's what I'm using. And then, of course, I take that. That's the price. I mean, $10 even. I mean, what are the odds? And then today, again, this video is being recorded July 21st, 2025. The price of ULTY is $6.39. So obviously it went down. It went down $3.61 in 277 days. Not ideal, but it happens. It is what it is, right? It did drop 36%. However, they did pay. If this is this added up right? Let me make sure. Okay, good. Yep. So no, they did pay a total of $4.93 in distributions. So if you add up the capital depreciation, I know it says appreciation, but it's actually depreciation, and the distributions of $4.93, you get $1.32. So if you take $1.32 and you divide it by $10, which was the essential launch price when we're doing this calculation, you get a total return of 13.21%. Oh yeah, I have a note here. 10/17 was X date post change. To be fair, because again, we're not counting the distribution, drop from that. So we're gonna count obviously anything as of 10/17, for these purposes, since that was X date. And then if you look down here again, this 493, this is the breakdown of it, right? So after 10/17, these are the distributions. They were paying 83 cents, 70 cents, 57 cents, 53 cents. But if you look here, it drops to 10 cents. Keep in mind, on March 12th, that's when they started the weekly pay. Again, they went from monthly. Well, I'm sorry, they actually went from every 4 weeks, right? They were monthly, then they did every 4 weeks, and then they went to weekly. Because of the demand, simply put, right? It was the demand from the people, and the people spoke. And a fund like this, honestly, they could probably handle weekly. And so they made the change. They made it to weekly. So you see here, as of when they started weekly, they paid 10 cents, 9 cents, 9 cents, 9 cents, 8 cents, 8 cents, 8 cents, 9 cents, 11 cents, 10 cents, 9 cents, 9 cents. So they have not gone down under 8 cents. And if you look at the yields, when they started weekly, or shall we say just since we started, since November of 24, the yield has always been in the, nothing less than 70%, nothing less than 72%, really. So, and if you average them, which I did at the top, if you average all these, the average yield comes to be about 81%. Which is, again, pretty damn good if you think about it. So now people like to compare like ULTY to other funds. So, looking at the total return, of 13.21%. Of course, this is not with drip. With drip, then forget about it, right? It would dominate. But during the same period, if you want to track, S&P 500, right? You could see that they went up 7.78% during that same time period, right? Because again, this is just pulling S&P then, S&P now, and then it shows S&P went up 7.78%. Now, ULTY went up 13, so obviously ULTY for the win. Now, I do not include distributions from the S&P or any of these indexes, just so you know. But honestly, is it enough to put to matter? Probably not, because they don't really, a lot of the funds in the S&P and the NASDAQ for that matter, or the Russell, don't pay too much of a dividend to make a difference. But either way, I'm showing ULTY is the winner for that. The NASDAQ, however, I think this was ULTY yesterday. I think the NASDAQ is up big today, actually. And I think it just put it above ULTY. So good job. This is live data, by the way, because again, when you pull the live price, which this is, it's a formula for Google Sheets, it'll show you the live price. And again, Google Sheets is kind of like a couple minutes delayed usually. But regardless, man, good job. NASDAQ took the lead with a 14% total return. All right. As far as the Russell actually shows it went down. So I'm showing negative 1.76%. But again, man, this is post like tariff news. I don't know. Obviously, you guys know that the market did tank during that whole tariff news crap, and it's somewhat recovered, but not fully. And obviously, the Russell never did recover fully. And don't I know, because I do trade options on TNA, which is triple leverage Russell. Also, some information over here. The average yield I said is 81%. The monthly yield comes to 6.8%. However, look at the capital appreciation, or shall we say depreciation, for 277 days. It comes to 36%. But if I annualize that, or if I calculate that to be daily, it's down 0.13% per day, which if you annualize that, it's negative 47%, which is not good, right? That's not good. But however, they are paying 81% per year. So if you add the two together, they're still going up 33%. Not ideal. So these aren't going to be the fantastic numbers that you see on a retire on Misty video, but it's still pretty damn impressive. And again, I think as time goes on, they'll learn how to make ULTY, a better and better performing fund. Knowing who is behind the scenes trading ULTY, obviously, I would feel, more and more comfortable as time goes on, as they decide, okay, that maybe this didn't work. Okay, let's try this, because it's still a new fund, right? In general. So anyway, so these are some numbers that I did use for the calculation. So I just want you to keep that in mind. All right. So now the actual calculation, most of the data is plugged in here. So again, maybe I'll just do like a few hypotheticals. Maybe for now, I'll plug in my my age, which now I'm 43 as of 2 days ago, unfortunately. So yeah, I'm an old fart. And let's just say I put in, right, one of my accounts. I think I have like 54,000, right? At least as of the last time I looked. Let's just say I put all my money, all 54,000, into ULTY. All right. Annualized it. How much do I put on an annualized basis? Actually, I've been trying to put 250 a month lately. So let's just do 250 times 12. And obviously, it'll calculate the monthly here. So that's 3,000 a year. And this shows you, okay, the capital gains annualized was 47. And the expense ratio is 1.3, right? 1.3, which, it's a lot, right? It's a lot, but this fund involves a lot of work. So, you have to understand that. So if you take that, right, you add these two and you divide it by 12, this is how much capital depreciation you get on a monthly basis, 4.08%. All right. So keep that in mind. However, right, we do know the monthly yield over here, you can see it calculates to be 6.8%. So obviously 6.8% is greater than 4.08%. So that's obviously a good thing. So the numbers will be up in our favor. Now, once I plug that in, we go to the calculations tab, and I'm just trying to explain to you how this, all works. So, it starts with, again, the age of 43, old as crap, the yield of 81%, starting capital 54,000, contributions 250. So right off the bat, we're starting with an annualized income of 44,000, right? Now, keep in mind, there is a depreciation of your capital of 2,200, and there is taxes, right? Taxes, right? Everyone always says you got to include the taxes. So what am I doing? I'm including the taxes. I include a tax rate of 22%, but you guys can use whatever the hell you want. It's up to you. And since I use that, right, it calculates 22% of the monthly income, and then it takes it from there, right? And then here's the total net monthly income. But if you look here, the new capital, let's make sure I'm doing this right, by the way. I think I checked this already, but it takes the old capital, 54,000, plus it adds what? J2, the monthly income, okay, plus the capital. See how it's moving? Obviously, the data is live. It adds the depreciation, which is obviously a negative number, so it actually decreases it by that. And then it says plus H2 contributions, and then minus taxes. All right, so obviously it subtracts out the taxes. So yes, it adds up the monthly income, it adds the contributions, and then it basically deducts out the depreciation and the taxes. And then it gets to the new number, the new capital of 54,913. Now, this chart is, of course, assuming 100% drip, this hypothetical, right? I don't have a thing where you could do 50% drip. I mean, should I add that? Maybe. It depends. If you guys whine enough, if you beg enough, if you ask enough, I should just said ask. But if you ask enough, yes, I will add it. I just haven't really thought about it until now, honestly. So let's just look as time goes on, right? And I have here month 12, year, and then the year obviously changes after month 12 and so on and so forth. So let's just say I'm 43 now, right? And then if I keep doing this, and let's just go to 50 years old. All right, so 50 years old, here I am. So now, all things being equal, I'm showing my capital could be at, actually, let's go to the end of the year, 50 years old, to get the best result. We have 216,000 in capital and an annualized income of 176,000. So yeah, that would be enough to basically live off of, right? Ideally. But let's just say I'm not comfortable. I'm going to wait a little bit. I'm going to wait till I'm 55, right? Because at least with my company, I know about the rule of 55. If you quit, the year you turn 55, if you leave your job, you can take out your 401k money. At least so I'm told. So if I wait till then, when I'm 55, yeah, I'll have 465,000 in capital. And that's an annualized income from ULTY of 379,000. And before we even go any further, guys, keep in mind, just because I'm plugging in the numbers based on history, it doesn't mean it's going to work out that way. Again, we could have a bear market, we could have a bull market. So the results could be better, the results could be worse. You just don't know. So always keep that in mind. This is just hypothetical. This is just having fun, plugging in numbers. What if? Just a what if, right? What's possible? But it's also a way to get you motivated, right? Get people motivated to start investing. It doesn't necessarily mean investing in high yield funds. It could be investing in dividend growth funds, right? But I'm more so interested in retiring early. So that's why I am in love with the high yield funds. Now, keep in mind, or I will keep in mind, obviously, most people actually that watch my channel are around the age of 43. But I will plug in, let's just say 20, let's say you're 25. Okay, you're 25. You probably have maybe 5,000 to to your name. Actually, hold on. I do have a chart here. I didn't even use it, but if you can see here to the right, this does show you the annual income after year 1, year 5, year 10, year 15. So obviously year 20, when I'm 63 years old, or this shows 62, I can make $1 million in income, which is obviously pretty damn amazing. But again, that's with 54,000 starting up front and with 250 per month. You can see obviously it keeps updating. All right, so now using a different, again, 25, what do we say, 5,000 bucks. And when you're younger, you probably can put more money in, right? So let's just say 500 a month, right? So again, year 1, you're making around 9,400 a year. Year 5, 43,000. Year 10, 123,000. And let's jump all the way ahead to year 20. You're making $631,000, which obviously I would assume, depending on inflation, that would be enough when you're 44 years old to retire. But again, keep in mind too, like these numbers, they're not fantastic, from $10 to 637. So the future could actually be better results, right? Are you expecting ULTY to go down 47% in capital every year? I mean, if you are, then fine, you can use these same numbers. But if you're not, then you could use more generous numbers. But I'm just using, again, based on what history shows, at least as of October 17th. You know what I mean? All right, let's throw in a few more. Let's just say, you know what? Let's say you're 50. Let's say you're 55 now, and you have like $300,000 to your name. You're not gonna put any more money, so let's get rid of that. So, is this enough for you to retire now? So let's look at your. Well, you know what? Let's just go to the calculation. Actually, it's probably easier to look at. Right off the bat, 244. That's how much you make. If I go, actually, let me check here. This shows the end of year 1, I believe. So it should have 279. Yeah, okay. So yeah, when it says year 1, it's the end of year 1, just so you know. Okay. I tried to make these red. It didn't, but I did something the other day and it didn't. So if you look off the bat, you'll make 244,000 annually, or $20,000 a month, if you had 300,000 and you put it all in ULTY. Because again, some people have that question. You will owe taxes, of course, 4,400 a month, right? It depends on your rate. It could be lower. Again, I just plugged in 22% because that's approximately what I pay. Also, keep in mind, a lot of ULTY is return of capital, so a lot of this may not even be taxed. But you can't always rely on that, because eventually your taxable cost basis will go down to zero the longer you hold these funds. So eventually you will have to pay taxes at some point. Again, not tax advice, but you have to track that yourself based on, at the end of each fiscal year, they'll tell you, well, your broker will tell you how much, was return of capital, how much was actually income. So, but hopefully, again, you plan ahead on that so you don't get destroyed. But anyway, going back to this tab, you can see if you waited to the end of the year, obviously you would make even more from there. So, again, like I said, I can share this with you guys. If you want to play around, have fun with it, man. Obviously, if you waited 20 years till you're 74, if you want to work that long, you can make 4.4 million a year if the numbers work out, right? We're not saying the numbers always work out that way, but again, this is just for hypothetical fun and entertainment, as we say, right? I'll do one more example and then maybe we'll call it a day. So let's just say let's say you buy ULTY for your kid, right? Your kid's maybe 2 years old, right? He starts out with $1,000, right? 2 years old, $1,000, and he gets like maybe between all the gifts, $300 a year. Let's just see what this works out to be. You buy him ULTY, you set it, forget it. You buy more ULTY as he gets more money. And then before you know it, he's 21 years old. He's bringing in $41,000 a year. Like, I mean, I don't think he'll be mad. Again, with these funds, with these income funds, I'd still for me, I'd rather like buy my son a growth fund, something like, the index, for example, or Apple, or maybe Broadcom, something like that, or MSTR, because again, if you're not using the money, if you're not using the income, why buy an income fund? But again, the numbers still look pretty damn impressive. So you gotta give it that. So could you imagine when your son turns 21? A lot of these accounts, these ULTY accounts, they're allowed to take the money at 18 or 21, and then could you imagine they start off, okay, I make $41,000 a year for doing nothing because my parents invested for me. So just imagine how thankful they would be for that situation. So anyway, guys, like I said, it's just for fun and entertainment. This is not financial advice. I am not a financial advisor. This video is for fun and entertainment. So hopefully you had fun. Hopefully you're entertained. If not, we'll try again next time. Again, this is the Retire on ULTY, part of the Retire on series. I need to do an updated Retire on Misty, and I'm sure there's others that I need to do, like Retire on PLTY, and then now the latest HOOY. HOOY, but we'll get to it. These videos are fun to make, but yeah, it's disappointing to see like the capital depreciation of 47%. But even with that, you can see how good the income is. They do what they can. They produce a solid income, and then again, if you go back here, look at, yes, it's dropped from 10 to 636, but since April it's been at 6. Oh, no, since March, it's been at 6, since they changed to weekly. And guess what? It's basically stayed there. So if we do this comparison as of March, oh, forget about it. You're going to be, whoo-wee. The numbers will be sweet. But we can't do that, that we can't make it work because it works out that way. But again, the way I did it, I made it as of the change of the prospectus to make it fair because, again, this is the new process. That if they make another change, fine, I'll do it as of that date. But again, this is as of the change, which was a big change, right? Which before that they were kind of limited with what they can do. But now, it's game on, man. Good luck. Trade ULTY, go for it, man. Again, this is a great fund. It's one of those funds. Well, I can't do this. I love options. I can't do what they're doing. So I'll pay them to do it and hope for the best. So yeah, have fun with it, man. I'll share this spreadsheet in my Discord. You guys can do whatever you want with it. Plug in the numbers, have fun, have a blast. All I ask is, just hit the like button and share this video with your friends and your family just to show them, what's possible. And again, tell them, not financial advice, of course, right? You got to cover your own ass. But anyway, guys, that's all I really got for this video. I hope it was helpful. If you guys see any errors, though, that you saw during this video, feel free to let me know, and I'll fix it. Hopefully, I don't have to redo it. But I think everything was up to date. But yeah, if you have any questions, let me know. If you see any issues, let me know. If you enjoyed this video, let me know as well. If you have a preference on the Retire Now series, leave that down below in the comments, and I will keep that in mind. All right. Sound good? All right, guys, this is my first pre-recording on the laptop. Again, I hope the visual worked out. If it did not, if it was hard to see, also let me know. But again, I'm going to try to start. Obviously, recording on the phone is awesome too, but today I got no kids in the house right now, so I have a little peace and quiet so I can actually stay in the house and not the garage. So I figured I'd, go for it. So yeah, let me know how it turned out. Let me know how the audio worked. Let me know how the visual worked, and we'll go from there. All right, guys. So I just wanted to say thank you for watching, and I'll catch you on the next video. Later.